Most people believe investing is complicated. They think you need special knowledge, secret strategies, or perfect timing to succeed. They watch experts on television, follow market predictions, and jump from one idea to another. Yet after years of effort, many still struggle to build real wealth. The truth is uncomfortable but simple. The biggest enemy in investing is not the market. It is our own behavior. We trade too often. We chase what is popular. We react to fear when markets fall and greed when markets rise. And without realizing it, we slowly give away our returns to costs, taxes, and poor decisions. But what if the path to wealth was not about doing more? What if it was about doing less but doing it consistently? This audiobook is built on a powerful idea. You do not need to beat the market to succeed. You only need to capture what the market already gives. The stock market over time reflects the growth of real businesses. Companies create products, serve customers, and generate profits. As these businesses grow, so does the market. This growth is available to every investor. Yet most investors never fully receive it. Why? Because they try too hard to be smarter than the system. This is where common sense investing begins. It is about simplicity, discipline, and patience. It is about trusting the long-term power of businesses instead of short-term noise. It is about keeping costs low and staying the course, even when emotions try to pull you away. To understand this idea deeply, we start with a simple story. A story that reveals how investors as a group create wealth, but as individuals often fail to keep it. This story is not just an example, it is a mirror. And once you see it clearly, you will never look at investing the same way again. Chapter 1. A Parable. Imagine a small village where all the people come together to own a single business. This business grows crops, sells goods, and earns profits every year. As owners, the villagers share in these profits. Over time, the business becomes more successful, and the total wealth of the village increases. At first, everything is simple. The villagers are patient. They understand that their wealth comes from the success of the business. So they hold on to their ownership and enjoy the steady growth. But then something changes. A few villagers begin to trade pieces of their ownership among themselves. One person sells because they feel uncertain. Another buys because they feel confident. Soon, more and more villagers join in. Prices begin to move up and down. Excitement grows when prices rise. Fear spreads when prices fall. The focus slowly shifts. Instead of thinking about the business and its profits, the villagers begin to focus on price movements. They start trying to predict who will buy and who will sell next. This creates a new kind of game. A game where villagers try to outsmart each other. At first, it feels like some are winning. A few traders make quick gains, others follow, hoping to do the same. But there is a hidden cost. Every trade involves a cost. There are fees, spreads, and small losses that add up over time. These costs do not disappear. They come directly out of the total wealth of the villagers. The business is still growing. It is still producing real profits, but the villagers as a group are now keeping less of that wealth. The more they trade, the more they lose. Over time, the situation becomes clear. While the business continues to succeed, the average villager earns less than the business itself produces. Why? Because they are playing against each other in a game where costs always exist. This is the key idea. Before costs, investors as a group earn the return of the market. After costs, they earn less. It is not possible for everyone to beat the market because the market is simply all investors combined. When one person wins, another must lose. And when costs are included, the group as a whole falls behind. This is why trying to outsmart the market is so difficult. It is not just hard. It is a losing game for most people. The smartest move is not to play that game at all. Instead of trading frequently, the wise investor stays invested. Instead of chasing prices, they focus on owning the entire business. Instead of trying to win against others, they accept the return of the market itself. This approach may feel simple, even boring, but it is powerful. Because when you remove unnecessary trading and reduce costs, you keep more of what the business earns. And over long periods of time, this difference becomes enormous. The parable teaches a timeless lesson. The stock market is not a casino where wealth is created by guessing correctly. It is a system where real businesses create real value. Your job as an investor is not to outsmart others. Your job is to participate in that value creation and avoid actions that reduce your share of it. Most investors fail not because they lack intelligence. They fail because they do too much. They react to noise. They chase trends. They believe they can beat the system. But the truth is simple. The more you trade, the more you pay. The more you pay, the less you keep. And the less you keep, the harder it becomes to build wealth. This is why simplicity wins. By owning a broad range of businesses through low-cost index funds, you align yourself with the growth of the entire market. You stop competing against other investors. You stop paying unnecessary costs. And most importantly, you allow time and compounding to work in your favor. This idea may seem too simple to be powerful, but simplicity is often misunderstood. It is not easy because it requires patience and discipline. It requires ignoring the noise and trusting the process. But for those who follow it, the rewards are clear. The parable is not just a story about a village. It is a reflection of how the real market works. And once you understand it, you begin to see investing differently. Now that you see how investors can turn a winning system into a losing one, the next step is to understand the forces that drive market behavior. In the next chapter, we explore how emotions, expectations, and excitement can push markets beyond reality. Chapter 2. Rational Exuberance. The stock market is driven by two powerful forces. One is the real growth of businesses. The other is how investors feel about that growth. Over time, businesses grow by earning profits, expanding operations, and serving more customers. This growth is steady and based on reality. It is the true foundation of long-term investing. But in the short term, something else takes control. Human emotions. Investors become excited when prices rise. They begin to believe that the future will be even better than the present. This optimism pushes prices higher and higher. At first, this rise may be supported by real growth, but soon, expectations go beyond reality. Prices start reflecting hope instead of actual value. This is what we call exuberance. It feels rational in the moment. Everyone seems to agree that things will keep improving. Experts provide convincing reasons. Stories of success spread quickly. The more prices rise, the more confident people become. And the more confident they become, the higher prices go. This creates a powerful cycle. Rising prices create excitement. Excitement creates more buying. More buying pushes prices even higher, but this cycle cannot continue forever. At some point, reality catches up. Business growth slows, or expectations become too unrealistic. When that happens, prices begin to fall. The same emotions that pushed prices up now work in reverse. Confidence turns into doubt. Doubt turns into fear. Fear leads to selling. And just as prices once rose too high, they can now fall too low. This is the emotional nature of markets. In the long run, stock returns come from three main sources: the growth of corporate earnings, the income from dividends, and the change in how much investors are willing to pay for those earnings. The first two are based on reality. The third is based on emotion. Over time, emotional changes tend to cancel out. Periods of high excitement are followed by periods of disappointment. This is why long-term returns are more stable than short-term movements. But for investors, this creates a challenge. If you follow your emotions, you will likely buy when prices are high and sell when prices are low. This is the exact opposite of what leads to success. Many investors believe they can predict these changes. They think they can enter before prices rise and exit before they fall. But in reality, this is extremely difficult. Even professionals struggle to time the market correctly. And when you add costs and taxes, the challenge becomes even greater. The better approach is to accept that short-term movements are unpredictable. Instead of trying to guess them, focus on what can be known. Businesses will grow over time. Markets will reflect that growth in the long run. This is where rational thinking becomes important. Rational investing means staying grounded in reality. It means understanding that prices may move away from true value in the short term. but they will eventually return to it. It also means controlling your own emotions. When markets rise rapidly, do not get carried away by excitement. When markets fall sharply, do not be overwhelmed by fear. Stay focused on your long-term plan. This is not easy. Human nature makes it difficult to remain calm during extremes, but this is where discipline creates advantage. Investors who remain steady while others react emotionally are more likely to succeed. They do not chase trends. They do not panic during downturns. They continue to invest consistently over time. Another important idea is valuation. Valuation reflects how much investors are willing to pay for each unit of earnings. When valuations are high, future returns tend to be lower. When valuations are low, future returns tend to be higher. This does not mean you should try to time the market, but it does mean you should have realistic expectations. High prices today often lead to more modest returns in the future. Low prices today often lead to better opportunities. Understanding this helps you stay prepared. It prevents you from expecting unrealistic gains during periods of high excitement, and it gives you confidence during periods of fear. The key lesson of this chapter is simple. Markets are influenced by both reality and emotion. Reality drives long-term results. Emotion drives short-term movements. If you focus on emotion, you will be pulled in different directions. If you focus on reality, you will stay on a steady path. This is why common sense investing avoids speculation. It does not try to predict short-term changes. It does not rely on excitement or fear. Instead, it accepts the market as it is. It participates in the growth of businesses, and it stays patient through all market conditions. Over time, this approach leads to more consistent and reliable results. Now that we understand how emotions influence markets, the next step is to return to the core idea of investing. You are not just buying stocks. You are becoming an owner of businesses, and this mindset changes everything. Chapter 3. Cast your lot with business. When you invest in the stock market, you are not just buying symbols or prices on a screen. You are buying ownership in real businesses. These businesses make products, provide services, and earn profits over time. This idea may sound simple, but many investors forget it. They begin to see the market as a place to trade rather than a place to own. They focus on price movements instead of business performance. They react to news, trends, and short-term changes. But the true source of wealth in investing is business growth. Companies grow by increasing their earnings. They expand into new markets, improve efficiency, and create value for customers. As earnings grow, the value of the business grows as well. Over long periods of time, stock prices follow this growth. This is the foundation of investing. If you own a share of a company, your return comes from the success of that company, not from guessing what others will do next. This is why it is important to shift your mindset. Do not think like a trader. Think like an owner. An owner does not panic when prices fall. They ask whether the business is still strong. An owner does not chase rising prices. They focus on long-term value. This mindset brings clarity. It helps you ignore short-term noise. It keeps you focused on what truly matters. Another important idea is that the stock market as a whole represents all businesses combined. When you invest in a broad market index fund, you are buying a small part of many companies. You are participating in the overall growth of the economy. This approach removes the need to choose individual winners. Because the truth is, predicting which companies will succeed is very difficult. Some companies grow rapidly. Others decline or disappear. Even experts struggle to identify consistent winners. By owning the entire market, you avoid this problem. You benefit from the success of strong companies, and the impact of weaker ones is reduced. Over time, the market naturally reflects the winners. Successful companies grow larger and have more influence. Unsuccessful companies shrink or are replaced. This process works in your favor when you own the whole market. It is a simple but powerful idea. Another key point is that speculation is different from investing. Speculation is based on predicting price changes. It depends on what others will do in the future. Investing is based on business performance. It depends on what companies actually achieve over time. Speculation is uncertain and often driven by emotion. Investing is grounded in reality and supported by long-term growth. Many investors confuse the two. They believe they are investing, but they are actually speculating. They buy based on trends, tips, or excitement. They sell based on fear or short-term losses. This behavior leads to poor results. To succeed, you must separate these ideas. Focus on investing, not speculation. Another important concept is dividends. When companies earn profits, they can return some of that money to shareholders. This is called dividends. Dividends provide a steady source of return. They are not dependent on market prices. Even when prices move up and down, dividends continue to be paid. Over time, reinvesting dividends plays a major role in building wealth. It allows your investment to grow faster through compounding. This is why dividends are important. They represent real returns, not just paper gains. Now consider the long-term perspective. Markets may rise and fall in the short term. There will be periods of uncertainty and volatility. But over decades, the growth of businesses drives the market forward. This is why patience is essential. If you stay invested and allow time to work, you benefit from this growth. If you constantly move in and out, you interrupt the process. You also increase costs and reduce your returns. Time in the market is more important than timing the market. This is one of the most important lessons in investing. Another advantage of focusing on business is that it reduces stress. When you stop worrying about daily price changes, investing becomes simpler. You no longer feel the need to react to every piece of news. You trust the long-term process. This creates a more peaceful and disciplined approach. It also helps you avoid mistakes caused by emotion. Because emotions are strongest in the short term, by focusing on long-term business growth, you move away from emotional decisions. You become more rational and consistent. The message of this chapter is clear. Investing is not about predicting prices. It is about owning businesses. When you align yourself with the growth of businesses, you align yourself with the true source of market returns. This approach is simple, but it requires discipline. It requires you to ignore noise. It requires you to stay patient, but for those who follow it, the rewards are powerful. Now that you understand the importance of thinking like an owner, the next step is to see how investor behavior can still create problems. Even when the system is designed to succeed, poor decisions can turn it into failure. Chapter 4. How most investors turn a winner's game into a loser's game. The stock market is designed to be a winning system. Businesses grow, earnings increase, and over time, investors as a group benefit from this growth. Before costs, the market delivers the return of all businesses combined. But after costs, the story changes. Investors, as a group, must earn less than the market itself. This is because costs are always present. These costs include fund fees, trading expenses, taxes, and advisory charges. Each one may seem small on its own, but together, they create a significant drag on returns. This is where the problem begins. Many investors believe they can outperform the market. They try to pick winning stocks or funds. They trade frequently, hoping to gain an advantage, but in doing so, they increase their costs. Every trade has a cost. Every fund charges a fee. Every short-term gain may trigger taxes. These costs reduce the total return available to investors. Now consider this carefully. If all investors together make up the market, then their average return must equal the market return before costs. After costs, the average must be lower. This means that the more investors try to outperform each other, the more they reduce their collective returns. It becomes a negative-sum game after costs. This is why the market, which should be a winning game, turns into a losing one for many participants. Another important factor is behavior. Investors do not always act rationally. They chase past performance. They buy funds that have recently done well. They sell funds that have recently done poorly. This behavior leads to buying high and selling low. It is driven by emotion, not logic. When markets rise, confidence increases. Investors feel safe and optimistic. They invest more money at higher prices. When markets fall, fear takes over. Investors become uncertain and anxious. They withdraw money at lower prices. This cycle repeats again and again. Over time, it leads to poor results. Even if the market performs well, many investors fail to capture those returns because their actions work against them. Another issue is overconfidence. Many investors believe they are above average. They think they can identify opportunities that others miss, but in reality, not everyone can outperform. For every winner, there must be a loser, and after costs, the number of losers increases. This is not a matter of intelligence, it is a matter of mathematics. The system is structured in a way that makes consistent outperformance very difficult. Professional managers face the same challenge. They compete against each other in a highly competitive environment. They have access to similar information. They use similar tools and strategies. As a result, their performance tends to average out over time. After fees and expenses, most actively managed funds fail to beat the market. Yet many investors continue to believe that they can find the few winners. This belief keeps them trapped in a cycle of switching and searching. They move from one fund to another. They follow trends and recommendations, but each change comes with a cost. And these costs quietly reduce their wealth over time. In contrast, the solution is simple. Instead of trying to beat the market, accept the market return. By investing in low-cost index funds, you minimize expenses. You avoid unnecessary trading. You reduce the impact of taxes. This allows you to keep a larger share of what the market provides. It also simplifies your investment process. You no longer need to make constant decisions. You no longer need to predict short-term movements. You focus on long-term growth and consistency. Another benefit is discipline. When you follow a simple strategy, you are less likely to react emotionally. You are less likely to chase trends or panic during downturns. This helps you stay on track. Over long periods of time, this discipline becomes a major advantage. Because investing success is not just about returns, it is about behavior. The best strategy will fail if it is not followed consistently, and the simplest strategy is often the easiest to follow. The key lesson of this chapter is clear. The market offers a positive return through business growth, but investor behavior and costs reduce that return. If you want to succeed, you must avoid these traps. Keep costs low. Avoid unnecessary trading. Stay disciplined. Do not try to outsmart the system. Instead, work with it. By doing less, you can achieve more. This idea may seem counterintuitive, but it is supported by both logic and evidence. The more you simplify your approach, the more likely you are to succeed. Now that we understand how costs and behavior can turn a winning game into a losing one, the next step is to focus on one of the most important factors in investing success: costs themselves. Because even small differences in cost can lead to large differences in results over time. Chapter 5. Focus on the lowest cost funds. Costs are one of the most powerful forces in investing, but they are often ignored because they seem small. A fee of 1% may not look like much in a single year, but over time, it takes away a large part of your wealth. This is because investing is based on compounding. Your returns grow on top of previous returns, but costs also compound in the same way. Every year, costs reduce the amount of money that can grow in the future. This creates a huge difference over long periods of time. Imagine two investors. Both earn the same market return, but one pays high fees, while the other pays very low fees. At the beginning, their results may look similar, but after many years, the difference becomes large. The investor with lower costs keeps more of the return. The investor with higher costs gives away a significant portion. This is why costs matter so much. They are certain, they are constant, and they directly reduce your results. Unlike market returns, which are uncertain, costs are guaranteed. This makes them one of the few factors you can control. Another important idea is that high-cost funds must overcome their expenses to match the market. If a fund charges higher fees, it must perform better just to break even with a low-cost fund. But consistently outperforming the market is very difficult. Most actively managed funds fail to do this over long periods of time. After fees, their results are often worse than simple index funds. This is not because managers lack skill. It is because the competition is intense and the costs are high. Even small disadvantages can lead to underperformance. Index funds offer a solution to this problem. They do not try to beat the market. They simply aim to match it. Because of this, they have lower costs. They do not require frequent trading. They do not need large research teams. This efficiency allows them to pass savings on to investors. As a result, index funds keep costs very low, and over time, this gives them a strong advantage. Another factor to consider is turnover. Turnover refers to how often a fund buys and sells its investments. High turnover leads to higher costs. It increases trading expenses. It may also increase taxes. Low turnover reduces these costs. Index funds typically have very low turnover. They hold investments for long periods. They only make changes when necessary. This helps keep costs down. Another hidden cost is advisory fees. Some investors pay advisors to manage their money. While advice can be valuable, it often comes at a high price. If the advice does not lead to better results, the cost becomes a burden. It reduces the overall return. This does not mean all advice is bad, but it should be simple, transparent, and reasonably priced. Paying high fees for complex strategies often leads to disappointment. Simplicity and low cost are more reliable. Another important idea is that costs are one of the few things you can control in investing. You cannot control market returns. You cannot control economic conditions, but you can control how much you pay. By choosing low-cost funds, you improve your chances of success. You keep more of what the market provides. This is a simple but powerful advantage. Over long periods of time, even a small reduction in costs can lead to a large increase in wealth. This is the power of compounding working in your favor. It is important to understand that there is no free lunch in investing. Higher costs do not guarantee higher returns. In fact, they often lead to lower returns. This is because costs are deducted regardless of performance. Even if a fund performs poorly, the fees are still charged. This creates a situation where investors bear all the risk, while costs remain fixed. Low-cost funds reduce this burden. They align your interests with the market. They allow you to participate in overall growth without unnecessary expenses. The message of this chapter is clear. Costs matter more than most people realize. They are silent but powerful. They work against you every single year. If you ignore them, they can quietly destroy your long-term returns. If you control them, they can significantly improve your results. This is why focusing on the lowest cost funds is essential. It is not about finding the best performing fund. It is about keeping as much of your return as possible. This simple shift in thinking can make a huge difference. Instead of asking, which fund will beat the market? Ask, how much will this fund cost me over time? The answer to that question often leads to a better decision. Low-cost index funds provide a clear path. They are simple, they are efficient, they are effective, and most importantly, they allow you to keep what you earn. Now that we understand the importance of costs, the next step is to explore another key source of return in investing: dividends. Because while prices may change, dividends provide a steady and reliable component of long-term growth. Chapter 6. Dividends are the investor's best friend. When people think about investing, they often focus on price changes. They watch stocks go up and down. They measure success based on how much prices increase. But there is another important part of investing that is often overlooked: dividends. Dividends are payments that companies make to their shareholders. They come from the profits that businesses earn. When a company is successful, it can share a portion of its earnings with investors. This is real money. It is not based on market opinions or price movements. It is based on actual business performance. Over long periods of time, dividends play a major role in total returns. In fact, a large part of the stock market return comes from dividends and their reinvestment. This is an important idea, because while prices can rise and fall, dividends provide a steady flow of income. They continue even when markets are uncertain. They continue even when prices decline. This makes them a reliable component of investing. Another key benefit is reinvestment. When you receive dividends, you can use them to buy more shares. This increases your ownership in the business. Over time, this creates a powerful compounding effect. Your investment grows not only from price increases, but also from the additional shares you accumulate. These new shares then generate their own dividends, and the cycle continues. This is how wealth builds over time, slowly, steadily, and consistently. Another important point is that dividends reflect discipline in business management. Companies that pay dividends must generate real profits. They cannot rely on promises or expectations. This encourages responsible decision-making. It also provides a signal of financial strength. However, it is important to understand that dividends are not guaranteed. Companies may reduce or stop dividends during difficult times. This is why diversification is important. By owning many companies through an index fund, you reduce the risk of relying on a single source of income. Some companies may struggle, but others will continue to perform well. This balance creates stability. Another misconception is that dividends are less important than growth. Some investors focus only on companies that do not pay dividends. They hope to earn returns only from price increases. But this approach can be risky. Price increases depend on market sentiment. They depend on what others are willing to pay. Dividends, on the other hand, are based on real earnings. They provide a more stable foundation. Over time, both dividends and growth contribute to total return. Ignoring dividends means ignoring a major part of the equation. Another advantage of dividends is psychological. Receiving regular income can help investors stay calm. It provides a sense of progress, even when markets are volatile. This can reduce the temptation to make emotional decisions. It helps investors stay committed to their long-term plan. Now consider the role of dividends during market downturns. When prices fall, dividends can soften the impact. They continue to provide returns, even when capital values decline. If reinvested during these periods, they allow investors to buy shares at lower prices. This can improve long-term results. It turns market declines into opportunities. Another important idea is yield. Yield represents the income you receive relative to the price of your investment. Higher yields may seem attractive, but they can sometimes signal risk. A very high yield may indicate that a company is struggling. This is why it is important to focus on overall quality and diversification, rather than chasing high yields. Index funds naturally balance this. They include companies with different dividend levels. They provide exposure to the entire market. This creates a stable and balanced source of income. The key message of this chapter is simple. Dividends are a vital part of investing. They provide real returns based on business performance. They support long-term growth through reinvestment. They offer stability during uncertain times. They are not exciting. They do not create headlines, but they are powerful because they represent the true earnings of businesses. And over time, those earnings are what drive wealth creation. Investors who understand this focus less on short-term price movements. They focus more on the steady flow of income and long-term growth. They stay patient, they stay disciplined, and they allow compounding to work in their favor. Now that we understand the importance of dividends, the next step is to explore another illusion that often misleads investors: the idea that market prices always reflect true value. Chapter 7. The Grand Illusion. Many investors believe that the stock market always reflects the true value of businesses. They think prices are accurate and fair at all times. This belief is comforting, but it is not always true. The market is influenced by human behavior, and human behavior is not always rational. Prices move based on what investors believe, not just what businesses are worth. This creates a gap between reality and perception. Sometimes prices rise far above the true value of companies. At other times, they fall below it. This is the grand illusion. The illusion that market prices always represent reality. In the short term, prices are driven by emotions, expectations, and speculation. In the long term, they are driven by business performance. This difference is important because if you focus only on prices, you may be misled. When prices rise quickly, it may feel like value is increasing, but in many cases, it is simply optimism growing. When prices fall sharply, it may feel like value is disappearing. but often it is fear taking control. This is why the market can appear confusing. It sends signals that are not always reliable. Another part of the illusion is the belief that experts can consistently predict market movements. Many investors follow forecasts and recommendations. They listen to analysts and commentators. But the truth is, predicting short-term market behavior is extremely difficult. Even experts are often wrong. This is because the market depends on countless factors. Economic conditions, investor sentiment, global events, and unexpected changes all play a role. No one can fully predict how these factors will interact. Yet the illusion remains strong. Because people want certainty. They want to believe that someone has the answers. This desire leads to overconfidence. Investors believe they can identify mispriced opportunities. They think they can buy low and sell high consistently. But in reality, this is very hard to achieve. For every investor who believes a stock is undervalued, there is another who believes it is fairly valued or overvalued. The market reflects all these opinions combined. This makes it highly efficient in many cases. Not perfectly efficient, but efficient enough to make consistent outperformance rare. Another illusion is the focus on short-term performance. Investors often judge success based on recent results. They chase funds that have performed well in the past year or two, but past performance does not guarantee future results. In fact, strong performance is often followed by average or below-average results. This is related to the idea of reversion to the mean, which we will explore later. The problem is that investors act on the illusion of recent success. They believe what has happened recently will continue. This leads to poor decisions. They buy when prices are high. They sell when prices are low. Another aspect of the illusion is market timing. Many investors try to predict when to enter and exit the market. They wait for the perfect moment to invest. They try to avoid downturns and capture upswings. But timing the market correctly is extremely difficult. Missing just a few of the best days can significantly reduce returns. And these best days often occur during periods of uncertainty. This makes timing even harder. The illusion of control can be dangerous. It gives investors a false sense of confidence. It encourages them to take actions that may harm their long-term results. In contrast, common sense investing accepts uncertainty. It does not try to eliminate it. Instead, it works with it. By investing in broad market index funds, you accept that prices may not always reflect true value in the short term. But you also trust that over time, business performance will prevail. This approach removes the need to guess or predict. It focuses on participation rather than prediction. Another important idea is patience. If prices move away from value, it may take time for them to return. This requires discipline. Investors must be willing to stay the course, even when the market seems irrational. This is not easy, but it is necessary for long-term success. The key lesson of this chapter is clear. Do not be misled by the grand illusion. Market prices are not always accurate in the short term. They are influenced by emotions and expectations, but over time, they align with reality. If you focus on short-term movements, you may be confused and frustrated. If you focus on long-term business growth, you will have clarity. This is why simplicity works. It removes the need to interpret every market movement. It allows you to stay focused on what truly matters. The growth of businesses. Now that we understand how market prices can mislead investors, the next step is to recognize another important factor that quietly reduces returns. Taxes. Because just like fees, taxes can have a significant impact over time. Chapter 8. Taxes are costs. 2. When investors think about costs, they usually think about fees. They look at expense ratios and trading charges. But there is another cost that is just as important. Taxes. Taxes are often less visible, but they have a powerful impact on long-term returns. Every time you sell an investment and make a profit, you may have to pay tax on that gain. This reduces the amount of money you can reinvest. And just like fees, this reduction compounds over time. The more frequently you trade, the more taxes you may pay. This creates a hidden drag on your portfolio. Now consider two investors. One trades frequently. The other invests for the long term and rarely sells. The first investor pays taxes regularly on gains. The second investor delays taxes by holding investments longer. Over time, the second investor keeps more money invested. This leads to greater compounding, and greater compounding leads to higher wealth. This is why tax efficiency is so important. It is not just about how much you earn, it is about how much you keep. Another important idea is the difference between short-term and long-term gains. Short-term gains are usually taxed at higher rates. Long-term gains often receive more favorable treatment. This means that frequent trading can lead to higher tax costs. Long-term investing helps reduce this burden. By holding investments for longer periods, you minimize taxable events. This allows your money to grow without interruption. Another source of taxes comes from fund activity. Actively managed funds often buy and sell securities frequently. This creates gains inside the fund. Even if you do not sell your shares, you may still be taxed on these gains. This can be frustrating for investors, because you may owe taxes even when you have not taken any action. Index funds are more tax efficient. They have lower turnover. They buy and hold investments for longer periods. This reduces the number of taxable events. As a result, investors keep more of their returns. Another important factor is dividend taxation. Dividends are often taxed when they are received. While dividends are valuable, taxes can reduce their impact. However, even after taxes, dividends remain an important source of return. The key is to manage taxes wisely, not to avoid dividends completely. Another useful approach is to use tax-advantaged accounts. These accounts allow investments to grow with reduced or deferred taxes. This can significantly improve long-term results. By combining tax-efficient investments with smart account choices, you can reduce the overall tax burden. Another important idea is that taxes are certain, just like fees. Market returns are uncertain. But taxes and fees are predictable. This means they should be carefully managed. Ignoring taxes can lead to disappointing results, even if your investments perform well. Many investors focus only on returns before taxes, but what truly matters is what you keep after taxes. This is your real return. Another common mistake is reacting to taxes in the wrong way. Some investors avoid selling losing investments to avoid realizing losses. Others hold on to poor investments simply to delay taxes. This can lead to poor decisions. Taxes should be considered, but they should not control your strategy. The goal is to balance tax efficiency with sound investing principles. Low cost, low turnover, and long-term holding periods naturally lead to better tax outcomes. This is another advantage of index investing. It simplifies the process, it reduces unnecessary activity, and it minimizes tax impact. Another key point is that taxes reduce compounding. When you pay taxes, you remove money from your investment. This reduces the base on which future returns are calculated. Over time, this creates a significant difference. Even small tax savings can grow into large amounts over decades. This is why managing taxes is essential for long-term success. The message of this chapter is simple. Taxes are a cost. They may not be as visible as fees, but they are just as important. They reduce your returns. They affect your compounding. If ignored, they can quietly take away a large part of your wealth. If managed wisely, they can be minimized. This allows you to keep more of what you earn. The best approach is not complex. Invest for the long term. Avoid unnecessary trading. Choose tax-efficient funds. These simple steps can make a big difference. Because in investing, success is not just about earning more. It is about losing less to costs and taxes. Now that we understand how taxes affect returns, the next step is to prepare for another reality of investing. Markets do not always rise. There are periods when growth slows or even stops. Understanding how to navigate these periods is essential. Chapter 9. When the good times no longer roll. Investing often feels easy when markets are rising. Prices go up. Portfolios grow. Confidence increases. During these times, many investors believe that success will continue without interruption. But markets do not move in a straight line. There are periods when growth slows. There are times when prices fall. There are moments when fear replaces confidence. This is a natural part of investing. Economic conditions change. Businesses face challenges. Unexpected events occur. These factors can lead to declines in the market. When this happens, it can feel uncomfortable. Investors see their portfolios lose value. They begin to question their decisions. They wonder if they should take action. This is where behavior becomes critical. Many investors react emotionally during downturns. They sell their investments to avoid further losses. They move to cash, hoping to wait for better conditions. But this reaction often leads to poor results. Because by the time investors feel safe again, prices have already recovered. They sell low and buy high. This is one of the most common mistakes in investing. Another challenge is that downturns are unpredictable. No one knows exactly when they will begin or end. Trying to avoid them completely is extremely difficult. Even professionals struggle to do this consistently. And missing just a few periods of recovery can significantly reduce long-term returns. This is why staying invested is so important. Markets have historically recovered from downturns. They have continued to grow over long periods of time. This does not mean every period is the same. Some recoveries take longer than others, but the overall trend has been positive. This is driven by the resilience of businesses. Companies adapt, innovate, and continue to create value. As long as this continues, the market has the potential to recover and grow. Another important idea is that downturns can create opportunities. When prices fall, future returns often improve. This is because you are buying at lower prices. For long-term investors, this can be beneficial. If you continue to invest during these periods, you acquire more shares. When the market recovers, these shares increase in value. This is the power of consistency. Instead of trying to avoid downturns, you use them to your advantage. This requires a shift in mindset. You must see market declines not as threats, but as part of the process. This is not easy. Fear is a natural reaction. But successful investors learn to manage this fear. They focus on their long-term goals. They understand that short-term losses are temporary. Another key point is diversification. By spreading your investments across many companies and sectors, you reduce risk. Not all businesses are affected in the same way during downturns. Some may struggle, while others remain stable or even grow. This balance helps protect your portfolio. Index funds provide natural diversification. They include a wide range of companies. This reduces the impact of individual failures. Another important factor is asset allocation. A mix of stocks and bonds can help manage risk. Stocks offer growth, but they can be volatile. Bonds offer stability, but lower returns. By combining both, you create a more balanced portfolio. During downturns, bonds can help reduce losses. This makes it easier to stay invested. Another challenge during difficult times is negative news. Media coverage often focuses on problems and uncertainty. This can increase fear and anxiety. Investors may feel pressure to act, but reacting to news often leads to mistakes. Markets already reflect available information. Trying to respond quickly can result in poor decisions. It is better to stay focused on your plan. Another important idea is time horizon. If you are investing for the long term, short-term declines should not change your strategy. What matters is where the market will be years from now, not days or months. This perspective helps you stay calm. It allows you to avoid unnecessary actions. Another key lesson is patience. Recoveries do not happen overnight. They take time. Investors who remain patient are more likely to benefit. Those who act impulsively often miss out. The message of this chapter is clear. Markets will have difficult periods. This is normal. It is not a sign that investing is broken. It is a natural part of the cycle. Your success depends on how you respond. If you react with fear, you may harm your results. If you stay disciplined, you increase your chances of success. Do not try to predict or avoid every downturn. Instead, prepare for them. Build a strategy that you can follow in all conditions. Stay consistent, stay patient, and trust the long-term growth of businesses, because even when the good times pause, they do not disappear forever. Now that we understand how to navigate difficult periods, the next step is to explore another challenge in investing: choosing long-term winners. Because many investors believe they can identify the best opportunities, but the reality is often different. Chapter 10. Selecting long-term winners. Many investors believe that success comes from picking the right stocks or funds. They search for companies that will grow quickly. They look for managers who can beat the market. The idea sounds logical. If you can choose the best performers, you can achieve higher returns. But in reality, this is much harder than it seems. The future is uncertain. Even strong companies can face unexpected challenges. New competitors can appear. Industries can change. What looks like a winner today may not remain a winner tomorrow. History shows this clearly. Many companies that were once leaders have faded over time. Others that were unknown have become dominant. Predicting these changes in advance is extremely difficult. Even professional investors struggle to do this consistently. They have access to research, data, and experience. Yet most fail to outperform the market over long periods. After fees and costs, their results are often lower than simple index funds. This creates an important question. If professionals find it difficult to select long-term winners, what are the chances for individual investors? The answer is clear. It is very challenging. Another problem is that past performance can be misleading. Investors often choose funds based on recent success. They assume that strong performance will continue, but this is rarely the case. Funds that perform well in one period often perform poorly in the next. This is partly due to changing market conditions. It is also due to the natural cycle of performance. Success attracts attention. More money flows into the fund. This can make it harder to maintain strong results. Another issue is costs. Funds that try to outperform often have higher fees. They trade more frequently. They require more resources. These costs reduce returns. Even if a fund performs well before costs, it may underperform after costs are included. This makes the challenge even greater. Another factor is luck. In any given period, some funds will outperform, but this does not always mean they have skill. It may be due to chance. Distinguishing between luck and skill is very difficult. Investors often assume that past winners are skilled, but over time, many of these winners fail to repeat their success. This creates a cycle of disappointment. Investors move from one fund to another, chasing performance. But each move comes with costs and risks, and the results often fall short of expectations. Another important idea is diversification. Instead of trying to pick a few winners, you can own many companies. This reduces the impact of individual failures. It increases the chance that you will benefit from overall market growth. Index funds follow this approach. They do not try to select the best companies. They include a broad range of businesses. This provides exposure to the entire market. As successful companies grow, they become a larger part of the index. As unsuccessful companies decline, their impact decreases. This process happens automatically. It removes the need for prediction. It simplifies investing. Another advantage is consistency. By owning the market, you receive the market return. You avoid the risk of underperforming due to poor selection. You also avoid the stress of constantly searching for winners. This creates a more stable and reliable experience. Another key point is time. Over long periods, the overall market has delivered positive returns. This is driven by business growth and economic progress. By staying invested, you participate in this growth. Trying to pick winners introduces uncertainty. It increases the risk of missing out on this long-term trend. The message of this chapter is clear. Selecting long-term winners is extremely difficult. It requires predicting an uncertain future. It involves high costs and risks. Most investors, including professionals, fail to do it consistently. Instead of trying to find the few winners, it is better to own the entire market. This approach is simple. It is effective. It is reliable. It allows you to focus on long-term growth rather than short-term selection. It reduces the need for constant decision-making, and it increases your chances of success. This does not mean that no one can outperform. Some investors may achieve higher returns, but identifying them in advance is very difficult. For most people, The simpler approach is the better choice. Accept the market return. Keep costs low. Stay invested. This combination provides a strong foundation for building wealth. Now that we understand the challenge of selecting winners, the next step is to explore another important concept in investing: the idea that performance tends to move back toward average over time. This is known as reversion to the mean. Chapter 11. Reversion to the mean. In investing, success does not stay in one place forever. Performance moves in cycles. What performs very well in one period often slows down later. What performs poorly may improve over time. This pattern is known as reversion to the mean. It is a simple but powerful idea. Extreme results, whether good or bad, tend to move back toward average over time. This happens because of competition, changing conditions, and natural limits to growth. When a company or fund performs very well, it attracts attention. More investors invest in it. Prices rise. As prices rise, future returns become lower. At the same time, competition increases. Other companies try to capture the same success. This makes it harder to maintain high performance. On the other side, when a company or fund performs poorly, expectations become low. Prices fall. If the business stabilizes or improves, future returns may increase. This creates a cycle. High performance leads to lower future returns. Low performance can lead to higher future returns. This is not exact in timing. It does not happen immediately. But over longer periods, the pattern becomes clear. This has important implications for investors. One of the most common mistakes is chasing past performance. Investors see a fund that has done well. They assume it will continue to perform well, so they invest after the strong performance has already occurred. But because of reversion to the mean, future returns are often lower. This leads to disappointment. The opposite can also happen. Investors see a fund that has performed poorly. They lose confidence and sell, but if performance improves later, they miss the recovery. This behavior creates a cycle of buying high and selling low. It is driven by misunderstanding performance patterns. Another important area where reversion to the mean applies is valuation. When stock prices become very high compared to earnings, future returns tend to be lower. When prices are low relative to earnings, future returns tend to be higher. This does not mean you should try to time the market, but it does mean you should have realistic expectations. High returns in the past do not guarantee high returns in the future. This is why long-term thinking is essential. Short-term performance can be misleading. It may reflect temporary trends rather than lasting value. By focusing on long-term averages, you gain a more accurate perspective. Another example is mutual fund performance. Many studies show that top-performing funds in one period rarely remain at the top in the next period. There is constant movement. Winners become average. Average funds may improve. This makes it difficult to select funds based on past results. Another factor is human behavior. Investors are naturally drawn to success. They feel more confident investing in something that has performed well, but this instinct can lead to poor decisions. Because by the time success is visible, much of the opportunity may already be gone. Understanding reversion to the mean helps you avoid this trap. It encourages you to stay disciplined. Instead of chasing performance, you focus on consistency. Instead of reacting to short-term results, you stay committed to your strategy. This approach reduces unnecessary changes. It also reduces costs and taxes. Another benefit is emotional stability. When you understand that performance moves in cycles, you are less likely to overreact. You do not become overly excited during strong periods. You do not become overly fearful during weak periods. You remain balanced. This balance is important for long-term success. Another key point is diversification. By owning a broad range of investments, you reduce the impact of any single cycle. Some parts of the market may perform well, while others may lag. Over time, these movements balance out. Index funds naturally provide this diversification. They include many companies across different sectors. This helps smooth the effects of performance cycles. The message of this chapter is clear. Performance is not permanent. It moves in cycles. High returns are often followed by lower returns. Low returns may be followed by improvement. Understanding this helps you make better decisions. It prevents you from chasing past success. It helps you stay patient during difficult periods. It keeps you focused on long-term results. Instead of trying to predict which investments will outperform next, accept the natural flow of the market. Stay diversified, stay consistent, and allow time to work in your favor. Now that we understand how performance tends to return to average, the next step is to examine another common belief: the idea that expert advice can help you select winning funds. But is this really true? Chapter 12. Seeking advice to select funds. Many investors believe that professional advice can help them choose better investments. They think that experts have special knowledge. They expect advisors to identify winning funds and avoid losing ones. This belief is understandable. Investing can feel complex. There is a large amount of information. There are many choices. Guidance seems helpful, but there is an important question. Can advisors consistently select funds that outperform the market? The evidence suggests that this is very difficult. Most advisors rely on past performance, research reports, and market forecasts. But as we have already seen, past performance is not a reliable guide to the future. Markets change. Conditions shift. What worked before may not work again. Another issue is that advisors themselves face the same challenges as investors. They operate in competitive markets. They use similar information. They follow similar strategies. This makes it hard to consistently achieve better results. After costs, many advised portfolios perform no better than simple index strategies. In some cases, they perform worse. This leads to an important idea. Advice can be helpful, but not in the way many people expect. Instead of trying to find winning funds, good advice should focus on behavior. It should help investors stay disciplined. It should encourage long-term thinking. It should reduce emotional decisions. This type of guidance can add real value, because behavior has a major impact on investment results. Another concern is cost. Professional advice often comes with fees. These fees may be charged as a percentage of assets. Over time, these costs can become significant. Just like fund fees, advisory fees reduce your returns. This creates a challenge. If the advice does not lead to better outcomes, the cost becomes a burden. It takes away from your long-term growth. Another issue is complexity. Some advisors recommend complicated strategies. They may suggest frequent changes or specialized investments. This can make investing harder to understand. It can also increase costs and taxes. Complexity often creates the illusion of value, but in many cases, simplicity works better. A clear and consistent strategy is easier to follow. It reduces mistakes. Another important point is incentives. Not all advisors have the same goals as their clients. Some may be influenced by commissions or product sales. This can create conflicts of interest. Investors may be guided toward higher-cost products that benefit the advisor more than the client. This is why transparency is important. Investors should understand how advice is provided and how fees are charged. Another key idea is that you do not need to predict the future to succeed. A simple approach based on low-cost index funds can provide strong results. This reduces the need for complex decision-making. It also reduces dependence on external advice. However, this does not mean advice has no role. For some investors, guidance can be valuable. It can help with planning, goal setting, and risk management. It can provide reassurance during difficult times, but the focus should be on supporting a sound strategy, not trying to outperform the market. The best advice often reinforces simple principles. Invest regularly, keep costs low, stay diversified, think long-term. These ideas may seem basic, but they are powerful when applied consistently. Another benefit of simplicity is confidence. When you understand your strategy, you are more likely to stick with it. You are less likely to be influenced by noise or short-term trends. This leads to better outcomes. Another important point is self-awareness. Investors should understand their own behavior. They should recognize their tendencies toward fear and greed. Good advice can help manage these tendencies. It can act as a guide during uncertain times, but it should not replace common sense. The message of this chapter is clear. Seeking advice to select winning funds is often ineffective. Most advisors cannot consistently outperform the market. After costs, the results are often average or below average. The real value of advice lies elsewhere. It lies in helping investors stay disciplined. It lies in supporting a simple and effective strategy. It lies in reducing emotional mistakes. For many investors, the best approach is straightforward. Use low-cost index funds. Keep your strategy simple. Avoid unnecessary changes. If you seek advice, make sure it aligns with these principles. Make sure it adds value beyond what you can achieve on your own. Because in the end, successful investing is not about finding the smartest strategy. It is about following a sound strategy consistently over time. Now that we understand the role of advice, the next step is to explore a powerful idea that brings everything together. The beauty of simplicity. Because in investing, doing less often leads to achieving more. Chapter 13. Profit from the Majesty of Simplicity and Parsimony. In investing, complexity is often seen as a sign of intelligence. Many strategies promise better results through detailed analysis and frequent decisions. But in reality, complexity often creates problems. It increases costs. It leads to confusion. It encourages unnecessary actions. And over time, it reduces returns. Simplicity, on the other hand, is powerful. It may not feel exciting. It may not attract attention. But it works. A simple investment strategy is easier to understand. It is easier to follow. And most importantly, it is easier to maintain over long periods of time. This is where parsimony becomes important. Parsimony means doing only what is necessary. It means avoiding excess. In investing, this means avoiding unnecessary trades, unnecessary funds, and unnecessary complexity. Every extra action has a cost. It may be a financial cost, such as fees or taxes. Or it may be a behavioral cost, such as stress or poor decisions. By reducing these actions, you improve your results. Another advantage of simplicity is clarity. When your strategy is simple, you know exactly what you are doing. You are less likely to be distracted by new ideas or trends. You stay focused on your goals. This helps you remain disciplined. Discipline is one of the most important factors in investing success. Even the best strategy will fail if it is not followed consistently. Simplicity makes consistency possible. Another key benefit is lower cost. Simple strategies often involve fewer transactions. They use low-cost funds. This reduces expenses. As we have seen, lower costs lead to higher long-term returns. Another important idea is that simplicity reduces errors. Complex strategies require many decisions. Each decision carries the risk of being wrong. Over time, these errors can add up. Simple strategies reduce the number of decisions. This lowers the chance of mistakes. It creates a more stable path. Another advantage is emotional control. Complex investing often leads to overthinking. It creates anxiety and doubt. Investors may constantly question their choices. This can lead to impulsive actions. Simplicity removes this pressure. When your strategy is clear, you do not need to react to every market movement. You trust the process. This helps you stay calm during both good and bad times. Another important point is that simple strategies are supported by evidence. Over long periods, low-cost index funds have outperformed many complex strategies. This is not because they are sophisticated. It is because they avoid the common mistakes that reduce returns. They keep costs low. They minimize trading. They stay consistent. Another key idea is that simplicity aligns with how markets work. Markets are driven by the growth of businesses. By owning the entire market, you capture this growth. There is no need to predict which companies will succeed. The market itself reflects this over time. Another benefit is flexibility. A simple strategy can be adapted to different goals. You can adjust your asset allocation based on your needs. But the core principle remains the same. Keep it simple. Another important idea is that simplicity is not about doing nothing. It is about doing what matters and avoiding what does not. It requires discipline and patience. It requires ignoring noise and focusing on long-term results. This is not always easy, but it is effective. Another common misconception is that simple strategies are too basic to succeed. Some investors believe that greater effort must lead to better results. But in investing, this is often not true. More activity often leads to more costs. More decisions often lead to more mistakes. Doing less can lead to better outcomes. This is a powerful lesson. Another advantage of simplicity is that it saves time. You do not need to constantly monitor the market. You do not need to analyze every new opportunity. This allows you to focus on other areas of life. Investing becomes a background process rather than a daily concern. Another key point is that simple strategies are accessible to everyone. You do not need special knowledge or resources. You do not need to compete with professionals. You can achieve strong results with a straightforward approach. This makes investing more inclusive. The message of this chapter is clear. Simplicity is not a weakness. It is a strength. It reduces costs. It reduces errors. It improves consistency, and over time, it leads to better results. Parsimony, doing less but doing it well, is a powerful principle. By focusing on what truly matters, you avoid unnecessary distractions. You create a clear path to success. In a world full of complexity, simplicity stands out. It is calm. It is steady. It is effective. Now that we understand the power of simplicity, the next step is to explore another important part of a balanced investment strategy: bonds. Because while stocks provide growth, bonds provide stability. Together, they create a more complete and resilient portfolio. Chapter 14: Bond Funds. When people think about investing, they often focus on stocks. Stocks offer growth and the potential for higher returns, but they also come with risk. Prices can rise and fall significantly over time. This is where bonds play an important role. Bonds are different from stocks. When you buy a bond, you are lending money to a government or a company. In return, you receive interest payments. At the end of the bond term, you receive your original amount back. This makes bonds more stable than stocks. They do not usually experience large price swings. They provide a steady source of income. Because of this, bonds help reduce the overall risk of a portfolio. They act as a stabilizing force. When stock markets decline, bonds often hold their value better. This balance makes it easier for investors to stay invested during difficult times. Another important idea is diversification. By combining stocks and bonds, you create a more balanced portfolio. Stocks provide growth. Bonds provide stability. Together, they help manage risk and return. The right balance depends on your goals, time horizon, and comfort with risk. Younger investors may prefer more stocks for growth. Older investors may prefer more bonds for stability. There is no single correct answer, but having a mix is important. Another key point is that bonds provide predictable income. Interest payments are usually fixed. This makes it easier to plan. For investors who need regular income, bonds can be very useful. Another advantage is that bond prices are generally less volatile than stock prices. This reduces the ups and downs in your portfolio. It creates a smoother investment experience. Another important concept is interest rates. Bond prices are affected by changes in interest rates. When interest rates rise, bond prices tend to fall. When interest rates fall, bond prices tend to rise. This relationship is important to understand. But for long-term investors, short-term fluctuations in bond prices are less important. What matters is the steady income and the role bonds play in reducing risk. Another factor is credit quality. Some bonds are issued by strong governments or companies. These are considered safer. Others are issued by weaker borrowers. These may offer higher interest, but come with higher risk. Diversification helps manage this risk. Bond funds provide an easy way to achieve diversification. Instead of buying individual bonds, you invest in a fund that holds many bonds. This spreads risk across different issuers and types of bonds. It also simplifies management. Another advantage of bond funds is liquidity. You can buy and sell them easily. This provides flexibility. Another important idea is cost. Just like stock funds, bond funds have fees. Low-cost bond funds are preferred. They help you keep more of your returns. High-cost funds reduce the benefits of bonds. Another misconception is that bonds are completely risk-free. While they are generally safer than stocks, they still carry risks. Interest rate changes can affect prices. Credit risk can affect repayment. This is why diversification and quality are important. Another key point is the role of bonds in emotional stability. During market downturns, bonds can reduce losses. This makes it easier to stay calm. It helps investors avoid panic selling. This behavioral benefit is very important because staying invested is critical for long-term success. Another important idea is rebalancing. Over time, the value of stocks and bonds in your portfolio will change. Stocks may grow faster. This can increase your risk level. Rebalancing means adjusting your portfolio back to your desired mix. This helps maintain balance. It also encourages discipline. You sell some of what has grown and buy what has not. This naturally leads to buying low and selling high. Another advantage of bonds is their role in preserving capital. For investors who cannot afford large losses, bonds provide protection. They help safeguard wealth. The message of this chapter is clear. Bonds are an essential part of a balanced investment strategy. They provide stability. They provide income. They reduce risk. They may not offer the excitement of stocks, but they play a crucial role. By combining stocks and bonds, you create a stronger portfolio, one that can handle both growth and uncertainty. This balance increases your chances of long-term success. Now that we understand the importance of bonds, the next step is to explore another popular investment tool: exchange-traded funds. These funds have become widely used, but they must be understood and used carefully. Chapter 15. The Exchange-Traded Fund, ETF. Exchange-traded funds, also known as ETFs, have become very popular among investors. They are often seen as modern, flexible, and convenient investment tools. At first glance, they appear similar to traditional index funds. Both allow investors to own a broad group of stocks or bonds. Both can offer low costs and diversification. But there is an important difference. Traditional index funds are bought and sold at the end of the day. Their price is based on the value of the underlying assets. Investors usually buy them with a long-term mindset. ETFs, on the other hand, trade throughout the day like stocks. Their prices change every minute based on supply and demand. This feature creates flexibility, but it also creates temptation. The ability to trade at any time may seem like an advantage, but it can lead investors toward behavior that reduces returns. Instead of holding for the long term, investors may start trading frequently. They may react to news, price movements, or market noise. They may try to time the market, buying and selling throughout the day. This turns investing into speculation. And as we learned earlier, frequent trading comes with costs. There are transaction fees, bid and ask spreads, and sometimes taxes. These costs may seem small at first, but over time, they add up and reduce total returns. The real danger of ETFs is not the structure itself, it is how they are used. If an ETF is used as a long-term investment, it can be very effective. It can provide low-cost exposure to the market. It can help investors follow a simple and disciplined strategy. But if it is used for frequent trading, it becomes harmful. The ease of trading creates an illusion of control. Investors may believe they can improve their results by making quick decisions. In reality, this often leads to worse outcomes. Another issue is the wide variety of ETFs available. There are ETFs that focus on specific industries. There are ETFs that follow narrow sectors. There are ETFs designed for short-term strategies. Some even attempt to multiply daily market movements. These complex products attract attention. They promise higher returns or unique opportunities. But they also increase risk and confusion. Many investors are drawn to these products because they seem exciting. They offer the possibility of quick gains, but excitement is not a reliable investment strategy. Simple, broad market ETFs are very different. They track the entire market or large portions of it. They are designed for long-term investing, not short-term trading. When used properly, they follow the same principles as index funds. Low cost, wide diversification, long-term discipline. This is the right way to use ETFs. The key is behavior. An ETF is just a tool. It can be used wisely or poorly. If you treat it like a long-term investment, it works in your favor. If you treat it like a trading instrument, it works against you. Another important point is liquidity. ETFs can be bought and sold easily during market hours. This makes them convenient, but it also increases the temptation to act on impulse. When markets move quickly, investors may feel the urge to react. They may buy when prices rise. They may sell when prices fall. This emotional behavior leads to poor timing. Long-term investors understand that daily price movements are not important. They focus on the overall growth of the market over years and decades. By ignoring short-term noise, they avoid unnecessary decisions. There is also the issue of pricing. While ETFs usually reflect the value of their underlying assets, their market price can sometimes differ slightly. This difference is usually small, but it is another factor to consider. For most long-term investors, this is not a major concern. But it shows that ETFs are not always perfectly aligned with their underlying value. The main lesson of this chapter is clear. ETFs are not inherently good or bad. Their value depends on how they are used. If used with discipline, they can be excellent investment tools. If used for speculation, they can harm your results. The simplicity of investing should not be replaced by unnecessary activity. The goal is not to trade more. The goal is to invest better. A simple approach remains the most effective. Own a broad market portfolio, keep costs low, stay invested for the long term. Whether you choose a traditional index fund or an ETF, the principle is the same. Do not let the ability to trade become a distraction. Do not confuse activity with progress. True progress in investing comes from patience, consistency, and discipline. In the end, the best investment strategy is not the most complex one. It is the one you can follow with confidence over time. Now that we understand ETFs and their proper use, the next step is to examine another idea. Some funds claim they can beat the market while still using an index approach. Is this possible? Let us explore this in the next chapter. Chapter 16. Index Funds that promise to beat the market. In the world of investing, there is always a strong desire for something better. Many investors are not satisfied with average returns. They want to do better than the market. They want higher returns without taking higher risks. This desire has led to the creation of a new category of funds, funds that claim to follow an index but also promise to beat it. At first, this idea sounds attractive. It combines the simplicity of indexing with the hope of superior performance. It feels like getting the best of both worlds. But this promise comes with a problem. If everyone could beat the market, then what would the market be? The market is simply all investors combined. For one investor to outperform, another must underperform. After costs are included, the average investor must fall behind the market. This is a basic truth of investing. So when a fund claims it can beat the market consistently, it is making a very difficult promise. These funds often use different strategies. Some adjust the weights of companies based on certain rules. Some focus on specific factors like growth or value. Some try to avoid certain stocks and favor others. While these approaches may sound logical, they introduce complexity, and with complexity comes cost. These funds often have higher fees than simple index funds. They may also have higher turnover, which leads to more trading and more taxes. All of these factors reduce returns over time. Another challenge is consistency. A fund may outperform the market for a period of time, but maintaining that outperformance over many years is extremely difficult. Markets are competitive and constantly changing. Strategies that work today may not work tomorrow. Many investors are attracted to these funds because of past performance. They see a strong track record and expect it to continue. But as we learned earlier, performance often reverts to the mean. Winners do not stay winners forever. Chasing past success often leads to disappointment. Another issue is understanding. Simple index funds are easy to understand. They track the market and aim to match its return. But these enhanced or modified index funds are more complex. Their strategies may not always be clear. Investors may not fully understand what they own. This lack of clarity can lead to poor decisions. When performance changes, investors may become confused or lose confidence. They may buy at the wrong time or sell at the wrong time. Simplicity reduces these risks. When you understand your investment clearly, you are more likely to stay committed. There is also a psychological factor. The idea of beating the market is exciting. It appeals to our desire to be above average. But investing is not about excitement. It is about achieving reliable long-term results. Trying to outperform often leads to unnecessary risks. And even if outperformance happens for a while, it is rarely sustained after costs. This is why the simplest approach remains powerful. A broad market index fund does not try to beat the market. It accepts the market return. By doing so, it avoids the costs and risks associated with trying to outperform. And over time, this leads to better results for most investors. Another important idea is discipline. A simple strategy is easier to follow. It does not require constant monitoring or decision-making. You invest regularly. You stay invested. You ignore short-term noise. This consistency allows compounding to work effectively. In contrast, complex strategies often require more attention. They may lead to more frequent changes. They may increase the chances of emotional decisions. All of these factors reduce long-term success. It is also important to remember that markets are efficient to a large extent. Prices reflect a wide range of information. Millions of investors are constantly analyzing and acting. Beating such a system consistently is extremely challenging. This does not mean it is impossible, but it does mean it is unlikely for most people. The goal of investing should not be to win a competition. It should be to build wealth over time. And for that goal, simplicity works best. The lesson of this chapter is clear. Be careful of promises that sound too good. Be cautious of strategies that add complexity without clear benefit. Focus on what can be controlled. Keep costs low. Stay diversified. Invest for the long term. Accepting market returns may not sound exciting, but it is realistic and effective. And in investing, realism is more valuable than hope. Now that we understand why trying to beat the market often fails, the next step is to look at what one of the greatest investors in history might have thought about this idea, a man whose principles shaped modern investing. Chapter 17. What would Benjamin Graham have thought about indexing? Benjamin Graham is known as one of the greatest teachers of investing. He introduced the idea of value investing. He believed that investors should focus on the true worth of businesses. He also believed in discipline, patience, and rational thinking. His approach was careful and thoughtful. He wanted investors to avoid speculation. He warned against emotional decisions. He emphasized the importance of safety and long-term thinking. Graham divided investors into two types: the defensive investor and the enterprising investor. The defensive investor prefers simplicity. They do not want to spend a lot of time analyzing stocks. They want a safe and reliable way to invest. The enterprising investor is more active. They are willing to study businesses and search for opportunities. But even for them, success requires effort, knowledge, and discipline. Now consider index investing. Index investing is simple. It does not require constant analysis. It does not depend on predicting the market. It provides broad diversification at low cost. These qualities align closely with Graham's ideas for the defensive investor. In fact, index investing can be seen as a natural extension of his philosophy. Graham believed that most investors should avoid trying to pick individual stocks. He understood that this requires skill and dedication that many people do not have. He also recognized that markets can be unpredictable in the short term. Indexing solves many of these challenges. By owning the entire market, investors avoid the need to select individual winners. They accept the collective result of all businesses. This reduces risk and simplifies the process. Graham also emphasized the importance of margin of safety. This means protecting yourself from errors and uncertainty. It means avoiding situations where small mistakes can lead to large losses. Index investing provides a form of safety through diversification. Instead of relying on a few companies, you spread your investment across many. If one company fails, others can succeed. This reduces the impact of any single mistake. Another key idea from Graham is emotional control. He warned that investors often act irrationally. They become overly optimistic during market highs. They become fearful during market lows. He described the market as something that can behave unpredictably in the short term. Index investors benefit from ignoring these short-term movements. They do not try to react to every change. They stay focused on long-term growth. This approach helps them avoid emotional mistakes. Graham also believed in keeping costs low. While costs were less discussed in his time, the principle remains important. Every dollar spent on fees is a dollar lost from returns. Index funds are designed to minimize these costs. This makes them more efficient over time. There is also the question of effort. Graham's enterprising investor must work hard to achieve better results. They must analyze financial statements. They must search for undervalued opportunities. Even then, success is not guaranteed. For most people, this level of effort is not practical. Index investing removes this burden. It allows investors to achieve solid results without constant effort. This makes it accessible to a wider range of people. Would Graham have fully supported index investing? While he lived before index funds became popular, his principles suggest that he would appreciate their benefits. He would likely see them as a sensible choice for defensive investors. He might still encourage knowledgeable investors to seek opportunities, but he would also recognize that most people are better served by simplicity. The core idea remains the same. Investing should be rational, disciplined, and focused on long-term results. It should avoid speculation and unnecessary risk. Index investing follows these principles closely. It does not promise to beat the market. It does not rely on complex strategies. It offers a straightforward path to participate in the growth of businesses. This is why it aligns so well with Graham's philosophy. The lesson of this chapter is important. Great investing is not about chasing excitement. It is about following sound principles. These principles do not change over time. Markets evolve. New products are created. Technology advances. But human behavior remains the same. Fear and greed continue to influence decisions. This is why simple and disciplined strategies continue to work. They are built on timeless ideas. By understanding these ideas, you gain clarity. You stop searching for shortcuts. You stop chasing trends. Instead, you focus on what truly matters. Long-term growth, low costs, diversification, patience. These are the foundations of successful investing. Now that we have explored how indexing fits with timeless principles, the next step is to understand how to build a complete investment plan. A plan that balances growth and stability. A plan that helps you stay on track through all market conditions. Chapter 18. Asset Allocation 1. Stocks and Bonds. Investing is not only about choosing good funds. It is also about how you divide your money. This decision is called asset allocation. Asset allocation means deciding how much to invest in stocks and how much in bonds. This is one of the most important decisions an investor can make. In many cases, it matters more than selecting individual investments. Stocks represent ownership in businesses. They offer growth over time. As companies earn more and expand, stock values tend to rise. But stocks also come with risk. Prices can move up and down quickly. There can be periods of strong gains and periods of sharp declines. Bonds are different. They are loans made to governments or companies. In return, they pay interest. Bonds provide stability. They usually do not grow as fast as stocks, but they tend to fluctuate less. This makes bonds useful for reducing overall risk. A portfolio that includes both stocks and bonds is more balanced. Stocks provide growth. Bonds provide stability and income. The right mix depends on the investor. There is no single perfect allocation for everyone. Each person has different goals, time horizons, and tolerance for risk. A young investor with many years ahead may choose a higher percentage of stocks. They have time to recover from market declines. An older investor may prefer more bonds. They may want to protect their wealth and reduce volatility. Risk tolerance also plays a role. Some investors are comfortable with market fluctuations. They can stay calm during downturns. Others may feel stressed when prices fall. They may be tempted to sell at the wrong time. Your allocation should match your ability to stay disciplined. If your portfolio causes you to worry or panic, it may not be the right balance. Another important idea is that risk and return are connected. Higher potential returns usually come with higher risk. Lower risk usually means lower returns. There is no way to completely avoid this trade-off. Asset allocation helps you manage this balance. By adjusting the mix of stocks and bonds, you can create a portfolio that fits your needs. A higher stock allocation offers greater growth potential. A higher bond allocation offers greater stability. Over time, markets will change. Stocks may perform better in some periods. Bonds may perform better in others. Your allocation helps you stay prepared for both situations. It also reduces the impact of extreme market movements. When stocks fall, bonds may provide support. When stocks rise, they drive growth. This balance creates a smoother investment experience. Another key concept is consistency. Once you choose your allocation, it is important to maintain it. As markets move, your portfolio will change. If stocks perform well, they may become a larger portion of your portfolio. If bonds perform well, they may increase in weight. Over time, this can shift your allocation away from your original plan. This is why rebalancing is important. Rebalancing means adjusting your portfolio back to your target allocation. It involves selling some assets that have grown more and buying those that have grown less. This process keeps your risk level consistent. It also encourages disciplined behavior. You are not chasing performance, you are maintaining balance. Asset allocation also helps reduce emotional decisions. When you have a clear plan, you are less likely to react to short-term market movements. You know your portfolio is designed for both good times and bad times. This gives you confidence to stay invested. Another important point is simplicity. Your allocation does not need to be complicated. A simple mix of broad stock and bond funds can be very effective. You do not need to constantly change your strategy. You do not need to predict market movements. A consistent and simple approach often works best. The goal is not to find the perfect allocation. The goal is to find an allocation you can stick with over time. Because the greatest advantage in investing comes from staying invested, not from making frequent changes. Asset allocation is the foundation of your investment plan. It determines how your portfolio behaves in different market conditions. It shapes your long-term results, and most importantly, it helps you stay disciplined. The lesson of this chapter is clear. Choose a balance between stocks and bonds that fits your goals and comfort. Keep it simple. Stay consistent. This is how you build a strong and stable investment strategy. In the next chapter, we go deeper into this idea. We explore how to maintain your allocation over time and avoid common mistakes. Chapter 19. Asset Allocation. 2. In the previous chapter, we learned that asset allocation is the foundation of investing. It defines how your money is divided between stocks and bonds. Now we go deeper into how to manage this allocation over time. Choosing an allocation is only the beginning. The real challenge is staying consistent with it. Markets are always changing. Prices move up and down. Some assets perform better than others in different periods. Because of this, your portfolio will naturally drift away from its original balance. For example, when stocks rise strongly, they take up a larger portion of your portfolio. This increases your overall risk. When stocks fall, bonds may become a larger portion. This reduces your growth potential. If you do nothing, your allocation will continue to change. This is why rebalancing is important. Rebalancing means bringing your portfolio back to its original allocation. If stocks have grown too much, you sell some of them. If bonds have become too small, you buy more of them. This keeps your portfolio aligned with your plan. Rebalancing may feel uncomfortable. When stocks are rising, selling them can feel like missing out. When stocks are falling, buying them can feel risky. But this is exactly why rebalancing works. It forces you to act against your emotions. You sell when prices are high. You buy when prices are low. This disciplined behavior improves long-term results. Another important benefit is risk control. Without rebalancing, your portfolio may become too aggressive or too conservative. Too much exposure to stocks can lead to large losses during market declines. Too much exposure to bonds can limit your growth over time. Rebalancing keeps your risk at the level you originally chose. There are different ways to rebalance. Some investors do it at regular intervals, for example, once a year. Others rebalance when their allocation changes beyond a certain level. Both approaches can work. The key is consistency. It is not about perfect timing. It is about maintaining discipline. Another important idea is avoiding unnecessary changes. Many investors change their allocation based on market conditions. They increase stocks when markets are rising. They reduce stocks when markets are falling. This behavior is driven by emotion. It often leads to buying high and selling low. A better approach is to choose an allocation based on your goals and stick with it. Do not let short-term market movements change your long-term plan. Markets are unpredictable in the short term. Trying to adjust your allocation based on predictions is difficult and risky. Staying consistent is more effective. There is also the question of age and time horizon. As you grow older, your allocation may change gradually. You may reduce your exposure to stocks and increase your allocation to bonds. This shift reflects a change in priorities. When you are young, your focus is on growth. When you are older, your focus may be on preserving wealth and generating income. But these changes should be gradual and planned. They should not be based on market fear or excitement. Another key idea is simplicity. You do not need a complex portfolio with many different assets. A simple combination of broad stock and bond funds is often enough. Complexity can create confusion. It can lead to more decisions and more opportunities for mistakes. Simplicity makes it easier to stay disciplined. It helps you focus on the long term. Costs also play a role in asset allocation. Frequent changes can lead to higher transaction costs and taxes. Rebalancing should be done carefully to minimize these costs. This is another reason why a simple strategy works best. It reduces the need for frequent adjustments. Another important factor is behavior. Even the best allocation will not work if you cannot stick with it. During market declines, it can be difficult to stay invested. Fear may lead you to sell at the wrong time. During strong market rises, excitement may lead you to take on more risk than you should. Discipline is the key to success. Your allocation should be something you can follow in all market conditions. It should give you confidence, not stress. A well-balanced portfolio helps you stay calm. It reduces extreme ups and downs. It makes the investment journey smoother. This increases the likelihood that you will stay invested. And staying invested is essential for long-term success. Another lesson is that perfection is not required. There is no perfect allocation that works in all situations. Markets change. Economic conditions change. But a reasonable and consistent plan will still work over time. Do not spend too much time searching for the perfect mix. Focus on creating a plan you can follow. That is what truly matters. The combination of asset allocation and discipline creates a strong foundation. It allows you to benefit from market growth while managing risk. It protects you from emotional decisions. It helps you stay on track toward your goals. The lesson of this chapter is simple. Choose your allocation carefully. Maintain it through rebalancing. Avoid emotional changes. Keep your strategy simple. This is how you turn a good plan into lasting success. Now that we understand how to manage a portfolio over time, the final step is to bring everything together. In the next chapter, we explore investment advice that has stood the test of time. Advice that remains true across all market conditions. Chapter 20. Investment advice that meets the test of time. After exploring all the ideas in this book, we arrive at the most important question. What truly works in investing over a lifetime? Markets change. Technology changes. New strategies appear and disappear. But some principles remain constant. These principles are simple. They may not sound exciting, but they have proven their value over time. The first principle is to invest for the long term. Wealth is not built in days or months. It is built over years and decades. Short-term market movements are unpredictable. Trying to take advantage of them often leads to mistakes. Long-term investing allows the power of compounding to work. Compounding means your returns begin to generate their own returns. Over time, this creates exponential growth. The second principle is to keep costs low. Every cost reduces your return. Fees, trading costs, and taxes all take a share of your investment gains. These costs may seem small in the short term, but over long periods, they make a big difference. By choosing low-cost funds and reducing unnecessary trading, you keep more of what you earn. The third principle is diversification. Do not rely on a single investment. Spread your money across many companies and sectors. This reduces risk. If one investment performs poorly, others can balance it out. Diversification creates stability and improves long-term outcomes. The fourth principle is discipline. Investing success depends more on behavior than intelligence. Even a good strategy will fail if it is not followed consistently. During market declines, it is important to stay calm. During market rises, it is important to stay grounded. Avoid emotional decisions. Stick to your plan. The fifth principle is simplicity. Complex strategies often lead to confusion and mistakes. Simple strategies are easier to understand and follow. They require fewer decisions. This reduces the chances of error. A simple approach also makes it easier to stay disciplined over time. The sixth principle is to ignore noise. Financial news, predictions, and opinions are everywhere. They can create anxiety and confusion. Most of this information is not useful for long-term investing. Focus on what matters: your plan, your allocation, your long-term goals. The seventh principle is consistency. Invest regularly. Do not wait for the perfect moment. The perfect moment rarely exists. By investing consistently, you reduce the impact of market timing. You participate in both high and low periods. Over time, this leads to more balanced results. The eighth principle is to understand risk. Risk cannot be avoided completely, but it can be managed. Asset allocation helps control risk. A balanced portfolio reduces extreme outcomes. Understanding your own risk tolerance is important. Choose a strategy you can follow in all market conditions. The ninth principle is patience. Success in investing takes time. There will be periods of slow growth. There will be periods of decline. Patience allows you to stay invested through these periods. It allows compounding to work fully. The 10th principle is to stay the course. This is perhaps the most important advice. Once you have a sound plan, follow it. Do not change it based on short-term events. Do not react to fear or excitement. Stay committed to your strategy. Over time, these principles work together. They create a strong foundation for building wealth. They help you avoid common mistakes. They keep you focused on what truly matters. The beauty of these ideas is that they are timeless. They do not depend on market conditions. They work in different environments. They have worked in the past. They continue to work today. They will likely work in the future. The final lesson is this: investing success is not about finding the next big opportunity. It is about following simple, proven principles with discipline and patience. You do not need to be perfect. You do not need to predict the market. You only need to stay consistent. By doing this, you give yourself the best chance to achieve your financial goals. This is the essence of common sense investing. It is simple. It is practical. And it works. Final message: own the market. Keep costs low. Stay diversified. Remain disciplined. Think long-term. And most importantly, stay the course.